And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us, and we appreciate the time. How's everything going in Chris's world?
Hey, we're doing real well up here, Peter. We have the mayflies that are coming out right now along the shore of Lake Erie, so that keeps things interesting when you wake up in the morning.
It just means boat season is right around the corner, Chris.
Yep, we're kind of in the heart of it, thankfully, after a cold spring. And I know we're going to get into a real good show here today, Peter. So I'm going to start off with the tip of the week, and there are a lot of different instruments and tools that you can use to plan your retirement. So if you think of a toolbox, the more tools you have in that toolbox, the more problems that you can solve. If you just have a hammer and a screwdriver, you're not going to be able to build your retirement plan. You need a number of different tools in there. Some of them have advantages and then disadvantages, and we'll go through that today.
Absolutely. Well, ladies and gentlemen, if you would like to examine all of the instruments, all of the tools, all of the investment options that you have in your toolbox, as well as the other ones that could be found on the shelves, all of the ones there at the good old Home Depot or Lowe's that can do just about any job financially that you might need done, you need to deal with a investment professional with experience, who is qualified, who has access to the full spectrum of the financial world and your best interest in mind. And that is exactly what Chris McIntire and his team there at McIntire Retirement Services do and are for their clients, the resource. And if you would like to have a conversation to review and evaluate your plan and all of the instruments and tools that you have, pick up the phone and give them a call. They'd love to hear from you, have a chat, a conversation, get to know you, get to know your goals, and then help you make sure that you are on the right track and evaluate your portfolio, the risks that you're taking, the fees that you're paying, how you have addressed the risks into and throughout retirement, and the number to get in touch to start that conversation, as well as get your complimentary, no cost, no obligation game plan for retirement put together is 419-332-0532, 419-332-0532. But Chris, one of the tools in particular that might be one of the most debated in the financial world is or are annuities. It is National Annuity Awareness Month. So on today's program, wanted to talk over the benefits, the disadvantages, the different features of annuities, what they can be used for, what to watch out for. And again, I think they are one of the most debated financial instruments, which is interesting that a financial instrument receives so much debate. So let's break it down here. What do annuities do well? What do they not do well? Who might want to consider an annuity? All and everything that we would need to know.
Yeah, and I think I'm going to start by kind of framing this debate. It's almost like a political conversation, right? One political aisle says you have to do it this way or you're completely insane. The other side of the aisle says you have to do it this way or you're completely insane. We want to cut through that minutia and that mindset if we can today. And, it reminds me of a commercial I see all the times. We don't sell commission-based products. Okay. So life insurance policies pay commissions, long-term care policies pay commissions. So how can you plan somebody's retirement if you're shutting out, an entire industry for clientele? So, we want to cut through that bias. We are also fee-based fiduciary advisors, and we do also participate in commission-based products like annuities, like life insurance, and like long-term care type plans as well, Peter, just to frame that.
Oh, annuities have seen record deposits every year over the last 4 years, Chris. They provide protection. They provide guaranteed income. Maybe it is the fact that this generation is seeing the value and the need for guaranteed income. Maybe it is a little risk aversion, that we are leery of the risks that are inherent in the market. Maybe it is a demographic need here. But regardless of this debate, we have seen more and more interest in and deposits towards annuities. Are you seeing this as an indication of those factors, or are there other things that might be driving this?
Yeah, a plethora of different options. When we talk about the annuity landscape here in general from the 30,000 foot level, we have Social Security is in a form of an annuity, right? Nobody sends their Social Security check back and says, I don't like annuities. Please don't pay me for the rest of my life, right? They paid into it so they get their monthly pension. My mom's a school teacher, so she gets a pension from the state teachers retirement system, on and on and on. And those are forms of more like an immediate annuity. A lump sum of money was turned over to, and a lot of times an insurance company that pays you a monthly income. Okay. We have people that say, look, I've got some money in a CD that was earning, 5% a few years ago, and now it's renewing at 2%. Say, do you have anything else? I said, yeah, we have a 3-year annuity paying 5%, for example. So after 3 years, you can decide to keep your money there, renew it, or do something different with it. You don't have to turn it into lifetime income. Okay. And those are tax deferred. So if you have after-tax money sitting in a bank CD, we call it lazy money. We refer to that typically on every show. If you have some lazy money that's earning next to nothing, heck, why not make 3 to 5% on that? Tax deferred, control when you pay the taxes on it. So that's a short-term annuity designed to compete with the short-term CDs or the short-term bonds, right? That makes perfect sense.
Yeah. And so, Chris, principal protection, tax deferred growth, guarantee of income. So an income problem and shortfall, we call it the income gap. Concern about the risk of the market, low interest rates on money that is already safe, wanting to get that growing a little bit more, longevity. All of these are problems that certain types of annuities can help solve. And maybe here's where the water gets a little muddier. There are different types of annuities. And so when we talk about them in general, we could be talking about one and not the other. And I think that's where maybe some of the confusion starts to enter the picture.
Yeah, and let's kind of relate this to stocks. There are people out there that would buy Walmart stock all day long, but they're not going to touch SpaceX because it's way too volatile, right? So, if there are certain stocks that have good times and bad times, that doesn't mean all stocks are good or bad, right? You
Mm-hmm.
don't put all your eggs in one basket. So, on the annuity landscape, there are many different types. So, we were just describing a MIGA, a multi-year guarantee annuity, just your basic fixed interest annuity. And like Peter said, principal protection, no fees typically on those short-term pieces whatsoever. You get a defined interest rate, contractually guaranteed. If you wanted to convert it into lifetime income, you could annuitize it. Okay.
Mm-hmm.
Most people don't do that on the short-term stuff. We step over to the next box and we'll call that a fixed index annuity, where your earnings are linked to the performance of a stock market index to give you higher upside potential, but still have that principal protection. Those typically range in a year of having the money invested for 5 to even 10 year time frames, right? Sometimes the longer you let the insurance company have the money, the more benefits they may give you, an upfront signing bonus, and you may even attach an income rider to that annuity. And again, rider is RIDER. So a rider is something that gets added, and it may have a fee associated with that. And what that fee does is it helps strengthen the insurance company's contractual promise of guaranteed lifetime income for you and your spouse, for those that are married out there. Okay, so you get, upside potential, downside protection, the ability to turn the income on when you want to or not. And, a lot of people might be listening today and say, well, I don't want to buy an annuity because if I'm starting to get income off of it and I die, that stops. The insurance company gets to keep my money, right? And, when we set annuities up and we turn on lifetime income, anytime that the client passes away, that rest of the money is going to go to the beneficiary. So it's not like a pension that when it stops, the money stops. A lot more of the annuities today have income riders so that the owners have the potential to leave money to beneficiaries. Okay.
And I think that was one of the next places where a lot of confusion and frustration used to enter the picture, Chris. But as you're saying, that quality of annuities where basically the lump sum was evaporated and there was no death benefit, that is describing annuities from a couple decades ago in general. Most annuities these days, while they still could have that, most don't have that when they are utilized properly, correct?
Yeah, yeah, absolutely. And you can structure you name beneficiaries so you're avoiding the probate system. You got spousal continuation rights, so they can solve a lot of problems. So we covered the MIGAs, the short-term fixed annuities, multi-year guarantees, the fixed index annuities. There are also variable annuities that allows you to participate directly in the stock market where you have upside and downside. And then typically you're going to have some other layered on expenses that could help with the income or a death benefit. And, we're not big fans of the variable annuities in full disclosure here because of the inherent risk. And then, a couple different layers of expenses on there. And we just think we can do it differently with, we use the safer side of annuities. We're generally working with more of the retirees who want some principal protection, a safe money type strategy, but also to help them solve that income gap that I think we'll transition to here as well.
Well, Chris, so here with the different types of annuities, if somebody says, "Well, I wanted safety and protection for my principal, but ended up with a variable annuity," like that's the wrong type of annuity, or we're looking at or considering the wrong type of annuity. If somebody said, "I want to get all of the growth of the stock market," but ended up with a fixed annuity, the wrong type of vehicle there. It's like somebody saying, "Well, I need to haul a whole bunch of lumber," and then driving off the lot in a Mini Cooper, or I want top fuel efficiency and just getting around the town and ends up with a mega SUV. It's like the wrong kind of vehicle here, even though all vehicles have some function that operates the same way. There are different types. Even though all annuities have some functions that are similar, there are different types that do different things. And again, this is where some of the complexity and the confusion enters into the conversation, and why I think it's important to deal with an experienced, qualified professional who has access to the full spectrum.
Yeah, absolutely. And we are retirement planners, not only just investment advisor representatives. So there are some firms, all they want to do is manage investments in the stock and bond market. That's nothing wrong with that, but you can't disparage the rest of the side of the industry that helps people with lifetime income. I mean, the number one concern for Americans is running out of money. Well, guess the only instrument on planet Earth that can prevent that from happening, contractually guaranteed with some of the world's largest corporations. I hate to tell you, that's a life insurance company issuing life insurance and annuities that can give you income for the rest of your life. So what kind of an advisor are you that doesn't want to utilize an instrument to take one of the major concerns away from millions of Americans?
And oh, by the way, Chris, as you've mentioned here, the rates are pretty attractive on these things. If you take a look and evaluate compared to other options that are out there, the rates are not too shabby right now.
Right. Yeah. I mean, how many people listening to this show today would put money into a 3-year CD paying between, let's say, 4.5% and 5.5%, depending on the bank? Okay. We can get that all day long in short-term annuities, depending on the insurance company, and sometimes we choose something with a lower rate because it might have more access to the cash inside of it. If you don't need any access to it for 3 years, then you're going to get a higher interest rate. And again, it's like it's having the ability to critically think and ask the right questions. What are the clients really after? And, when you get some volatility in the stock market, hey, we have several clients that say, you know what, we've done pretty good over the last several years. Can we carve off some of these gains and put them someplace safe so we can use it down the road? And yeah, absolutely. Yeah, we have those tools.
Now, Chris, you mentioned that number one fear of retirees running out of money, and you have spoken many times about the process for defining and filling the income gap. The income gap is how much withdrawal we will need to take on a monthly basis from our investment portfolio. Well, when those withdrawals start to happen, that's when there's the potential for the portfolio to begin to decrease over time. And depending on the rate and how much, and as well as, market volatility, what it's invested in, that is going to determine our financial future. But annuities can specifically be positioned to address and solve for that income gap problem, correct?
Yeah, exactly. And so, we'll talk a couple different strategies in general and try to bear with us here, guys. I'll try to paint a visual picture for those of you who are listening versus watching. And, let's say we'll use a big round number. Somebody walks in the office with $1 million, okay? And they need, they need access to get $30,000 a year from that $1 million, okay? So if we said, all right, well, hey, why don't we take $300,000 of that money. Let's go over here and put it into an annuity of some sort, a fixed annuity, an index annuity that we utilize, 300,000, okay? And then we've got 700,000 in an investment portfolio that we need to spin off $30,000 a year. So that's just over 4%. And that's pretty easy to do in this interest rate environment with good dividend paying stocks and structured notes. So we can do that out of the investment portfolio. But what happens when the stock market, let's assume it takes a 25% correction, and we're dealing with a more of an aggressive investor. Then, we certainly don't want to pull money out of that investment portfolio. We can say, hey, let's go over here to the annuity, and all we got to do is make a one-time withdrawal of $30,000. We put in 300,000, so we can typically make a free withdrawal of 10% of the annuity's value. Hey, we got a year's worth of cash flow here. We just took pressure off the portfolio.
Okay. So why would we consider that versus just the market-based solution and drawing off investments, Chris?
There's no contractual guarantees that those stock market investments are going to pan out the way you want them to every single year or month of your life, where, using, something that's structured like an annuity, even a good quality life insurance policy, that where we can get that structural payments contractually guaranteed from some of the biggest corporations on the planet, very well capitalized. And again, I think it's probably safe to assume we need to state that, annuities, their paying claims are based on the financial conditions of the issuing insurance company. So you have to do your due diligence to make sure that you're using a good quality company. Like, we can think there's a big building in Chicago, right, that's named after an insurance company, and, companies that have been around for hundreds of years here to help put some peace of mind to some of the folks listening today onto the safety aspects.
And there's background into their financial strengths and ratings agencies that do some due diligence, of course. So you want to deal with that well-rated company. But Chris, we talked a couple weeks ago about the comparison of potential versus probability. And so that's what you're talking about here. There's market speculation and hope versus these contractual guarantees. And that's really the comparison here is do we want the potential for things to go well, or do we want the higher probability that things will go well, correct?
Yeah, absolutely. Look, I have money invested in the stock market personally, a lot of it. And, because I believe in the long-term performance of the stock market. I'm not relying on it for income as you and I are recording this show right now, And so, does the stock market correction, it doesn't get me too emotionally involved right now, but we got enough gray hair on our heads that we've sat in enough of these meetings. We know what it means to our clientele that, have just retired, and, some of them are very risk adverse. So we certainly employ a lot of other safer strategies, even on the investment side. We invest them a lot more in bonds than we do stocks. But they're obviously more open to the annuity side of things because it's good and safe. And, look, annuities typically pay some form of commission. Okay? We have a book of business with Charles Schwab and Fidelity that is fee-based, that we manage and charge a fee for that. So, You know, Peter, I may have a meeting at 10 o'clock in the morning and somebody says, look, as long as the insurance company's paying you, I don't care what we do, you know.
Mhm.
Then my next meeting is, look, I don't want to get involved in anything to do with the commission-based side of things. I've seen enough TV commercials and, Google is the bathroom wall of the internet, let's be honest. And so, I've read a number of things there. I'd rather stick with the fee-based investment portfolios, so, you run into that different spectrum across clientele. Our job is to cut through all that noise and say, look, let's lay it out. Here's the facts, not the emotion. Make a good quality decision based on what the clients are looking to achieve. David Gaylor wrote the book Income Allocation. May he rest in peace. And he explained that by utilizing a good quality annuity that may have a nice income feature to it actually frees up more money on the investment side because you're not relying on it for income. You can actually invest more aggressively because you've hedged that stock market risk.
We're talking again with Chris McIntire, president and founder of McIntire Retirement Services. If you've got questions, if you would like a complimentary review, evaluation, analysis of your portfolio, if you would like to have your game plan for retirement constructed, a personalized plan with diversified strategies and long-term vision to help you achieve and accomplish your goals. No cost, no obligation. It is a courtesy service that they offer to put together that plan for you. Just give a call, start the conversation, 419-332-0532. 419-332-0532. I'm going to put an issue in a different light and in a different way, Chris. You mentioned that the number one fear of retirees running out of money. In other words, we worry about living too long. Something that it would seem we would hope for is actually putting a financial stress and concern on us. Having guaranteed streams of income, such as Social Securities and pensions, once helped to address that concern. But today, with our lump sum generation and the 401ks, the pensions have gone away. Social Security is not covering 100% of income and in jeopardy of being reduced at some point into the future. That there is more and more concern with that longevity. We need a plan specifically geared to address longevity as a risk in our financial lives.
Yeah, because longevity risk is a risk multiplier. So, Peter is 32 years old as you look at him on the
I
TV
am
screen
not.
there.
I am not. I appreciate that, Chris.
But Peter's got a longer life expectancy than I do at age 61, obviously. So he has more longevity risk associated with him. If we're dealing with people in retirement and somebody that retired early at, say, 62 years old, took their Social Security at 62, they're locking in the lowest amount that they're going to get. Okay. So, inflation is going to be a risk multiplier because of that, especially if their parents and grandparents all live to be in their 90s. So, we need to have strategies in there to mitigate inflation risk, which was caused by longevity risk. Obviously, the longer they're going to be retired, the more time things can happen, good and bad, in the stock market, the bond market, the interest rate market, survivorship income, long-term care. So, the longer you have to live, the more risks that are going to be, that you'll be subject to. And to relate that into investment terms, a 30-year bond that doesn't mature for 30 years has a lot more risk to it than one that's going to mature in 3 years.
Sure. Chris, again, evaluating the benefits, the strengths, and the disadvantages and drawbacks for the potential of annuities here for Annuity Awareness Month, the month of June. We've talked a lot about the benefits of annuities. What does somebody who might consider an annuity need to know that might be a deterrent or a detriment or a drawback in some form or fashion? For every pro, there's a con, or at least they need to be evaluated the weight of both.
Yeah, absolutely. And this is where, having that plethora of tools in the toolbox certainly helps you solve these conditions. So, if we've got somebody that has a high degree for liquidity needs, we don't want to over allocate too much to a 5-year annuity if they need money within that substantial money within that 5-year time frame. So that's one of the pieces there. And then, like you said earlier, if somebody wants real aggressive growth, out of their entire portfolio. Okay, they probably don't want a fixed rate annuity. They may want something that can deliver some higher upside potential, and maybe that's not in the annuity landscape whatsoever. You know, if we have somebody on example that says, "Look, I want to lock in some guaranteed income to complement my pensions, to make sure I've got my monthly living expenses met." That's the perfect scenario for some form of, income generating vehicle like an annuity there, because it's contractually guaranteed. If we're talking with a husband and a wife, typically the husband's going to want to say, "Look, I'm probably going to die first. I want to make sure that if something happens to me, that my wife has the guaranteed income that she needs. So let's get an annuity that she can assume now. And, the sooner we get it, the higher the income will be later on down the road." So we have some deferred income annuities, things like that, hey, you can start now and you can choose when you want to take it out for income. And it may be 5 to 7 years from now. That income payout percentage can also increase over time. Okay.
Uh,
So a couple of examples there, the good, the bad, and I don't want to say, use Clint Eastwood, the good, bad, and the ugly, right?
Sometimes,
Yeah.
right? Because they can be misplaced. That could get a little complicated and ugly. They could be misrepresented. That could be a little complicated and ugly. We might be looking at the wrong thing. I know a lot of discussion has centered around some upfront bonus that may or may not ultimately be the most important factor. So again, there is room for complexity leading to complications, confusion, misunderstanding, and misplacement. So we do need to be careful. And again, I think that's why, Chris, important to deal with an experienced qualified professional, one with the full spectrum of access to the financial world. And again, ladies and gentlemen, that's why I think that the conversations with Chris McIntire and his team there at McIntire Retirement Services can be so impactful and valuable for savers and investors, is weighing the pros, the cons, the benefits and disadvantages of all financial instruments, and then arriving at a conclusion of what might be most appropriate for you to achieve certain goals and objectives. And if you'd like to start that conversation, review and evaluate your current set of tools, your current portfolio, and get your game plan for retirement put together, just start the chat by giving a call, 419-332-0532, 419-332-0532. Chris, I think we'd be remiss if we did not also mention that some of these annuities now can include an element of some healthcare protection as well. I know healthcare expenses are also a big concern for retirees, and I'm not sure if there is a perfect solution or one that is completely comprehensive, but having the healthcare benefits included as part of the annuity design, I do think adds a certain level of strength to an overall portfolio, correct?
Yeah, absolutely. And the shirt I'm wearing right now comes from an insurance company. I'm going to keep it hidden here, but they, one of the annuities that they offer has a long-term care element to it. So, for example, if you put in $100,000 at age 60 into the annuity, it may guarantee you $300,000 of annuity payments immediately, again, paid out on a monthly basis. And then as time goes on, that bucket of money for the long-term care continues to grow. And the annuity typically will pay a fixed rate, or, there's even companies that will give you that indexing potential for growing, like with the S&P 500. There are other companies that may pay you a nice solid income stream, but if you went into the nursing home, for example, it would double the amount of money that it was paying. And in fairness, there's probably not a lot of people out there that are going to put that much money into an annuity that's going to pay them $10,000 a month for 60 months in a nursing home. So, we do these things to help solve problems. We don't put people in Cadillacs when they need a Chevy. You know what I mean?
Yeah. But perhaps, Chris, the biggest mistake with annuities is painting with too broad of a brush, that they are always good or the solution for every financial problem or concern, or that they are always bad, maligned, and misplaced. So don't paint with too broad a brush on annuities, nor any financial instrument, ladies and gentlemen. Understand that there are choices and options and a variety of tools for a reason, because we need different jobs done, and money is generally not the best multitasker. We need different tools to help us achieve and accomplish those different goals. So again, if it is Annuity Awareness Month, and we are having a discussion specifically about annuities on today's program with Chris McIntire. But if you would like a discussion about all of the tools that are available, helping you evaluate the tools that you currently have, and assessing whether they are the most appropriate to achieve your goals, that's a conversation to have specifically with your advisor. And if you have not had that or would like to review those conversations and what you have, give a call to Chris McIntire. He does offer the opportunity for a complimentary review, retirement planning strategy session, and help to construct your game plan for retirement. 419-332-0532, 419-332-0532. Specifically, if you'd like the plan to generate more income, address your risk, and reduce taxes in retirement, that is the game plan for retirement. Pick up the phone, give a call, request yours today, 419-332-0532. Chris, we always appreciate your time here on Your Game Plan for Retirement.
Hey, my pleasure. Good to be with you, Peter. Everybody take care, be safe, and may God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Investment in notes involves risks not associated with investment in ordinary debt securities. The securities are not bank deposits and are not insured by the FDIC or any other government agency, nor are they obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and there may be little or no secondary market for these securities, and secondary trading may be limited. Accordingly, you should be willing to hold your note security to maturity. These securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit ratings or credit spreads may adversely affect the market value of the securities.